What is private mortgage insurance? You might have heard of it. Let's talk about what it is. This is Aaron Chadbourne at Demetrius Team, the real estate group, and our team has the experience to help you navigate any aspect of the buying or selling process in the real estate market. Private mortgage insurance, or PMI as it's often referred to, is a concept that comes up and often confuses first-time home buyers who are just trying to figure out how much money can I borrow based on what my income is and what my savings are. So let's talk about what private mortgage insurance is, why it exists, whether or not you should pay it, and how to get rid of it. Private mortgage insurance is an insurance policy that a lender makes you buy for them. Let me say that again. Private mortgage insurance is an insurance policy that a lender makes you, the buyer, or the borrower in this case, buy to protect the interests of the lender. Why do they do that? Well, the times that you see private mortgage insurance tend to be when you can only afford, or you're choosing to, put a down payment of less than 20%. There are some products from some lenders, credit unions being one of them. We work with QSO Mortgage quite a bit, and they offer the CU Promise program. You can get it through other credit unions as well. The CU Promise program will allow you to have 10% down with no PMI. And so it's important to know why it is that you have to do it. If you're only putting 3% down or 5% of a down payment on a house, that means that if you're buying a $500,000 house, if you're putting 5% down, that means all you're spending in order to get a $500,000 house is $25,000. That seems like a deal to me, right? If you can get someone to give you that amount of money, $475,000, now you're paying interest on it, but statistically speaking, people who put down less than 20% on their down payment, so the bank is putting more than 80% of the purchase price of the home, are statistically more likely not to repay their mortgage, or to default, or to fall in financial trouble. The amount of a down payment is sometimes a signal of financial strength. And that's not to say that if you only have 3% down or 5% to be able to put down, that that's a bad thing. That might just reflect what your current situation is. Especially if you're at the beginning of your career, or maybe you're using a VA loan, or maybe you need a lower down payment so you can keep some of the savings that you have in order to make repairs to the house later. Those are all perfectly fine reasons to have a lower down payment. But the bank looks at this, or I'm going to use the words bank and lender interchangeably. There are lenders that aren't banks, right? Credit unions, mortgage brokers will shop them out to other types of investors. But the lender is going to look at you and say, statistically speaking, if you're putting less than 20% down or 10% down in the case of the credit union, then it's more likely that you're going to run into trouble and maybe not be able to pay your mortgage. So I'm going to make you pay for an insurance policy that will make me, the lender, the bank, whole financially if you don't pay me back. And now you're saying to yourself, wait a minute, I thought that if I don't pay my mortgage back, the bank just gets to take the house, right? Like, that's the whole thing about foreclosure. When you sign to get your deed, you're also signing that promissory note and that mortgage that gives the bank the right to the property in the event you don't pay them back. And that is absolutely true. But over and above that, there are costs involved when a lender has to foreclose on a house. They have to go through the legal process. They have to then own the property, maintain the property, winterize the property if there's not going to be anyone living there. They might need to make repairs if it's been vacant or if there's been damage from the prior occupant. And so they want to make sure that they've got extra protection that's going to cover some of those extra transaction costs. Now, how expensive is private mortgage insurance? It depends how much money you're putting down. It depends what the purchase price of the house is, how much the loan is. It's complicated, but let's just say it can easily be a few $100s a month. So for the benefit of borrowing more than 80% of the purchase price of your home, you're going to have to pay a few extra $100s a month, maybe, in private mortgage insurance. Some people don't like that because you're not getting any extra benefit. But the benefit you are getting is being able to borrow more than kind of the normally allowed amount. So maybe it's worth it for you. Maybe that's the way that you're able to purchase. Maybe you have the ability to pay more on a monthly payment basis, but you don't have a lot of savings. So maybe this is a good deal for you, and it might be. But other people say, look, PMI, I'm not getting anything for that. That's an insurance policy for the bank, and I get no benefit. I'm paying more money a month for the same house. Well, then let's look at your options. And that's why I talk about the CU Promise program that the credit unions offer, because if you can come up with 10%, which is still a lot of money, depending on how much of the price of the house is, it's a significant amount of money. But if you can come up to 10%, we can often get rid of that PMI. Another option you have, though, is that PMI doesn't last forever, and that's important to know. You only have to pay the private mortgage insurance until you've paid down the principal on the loan so that you've got at least 20% skin in the game. It's a lot harder for someone that's built up at least 20% equity in a property to just turn around and walk away from that equity, from that investment, from that real money investment in the property. And that's what the bank knows. And so at 20%, you can ask to have your private mortgage insurance removed. Well, that also is a moving target because property values have gone up significantly. And so when we're talking about equity in a house isn't just the amount of money you paid in. If the house value has gone up, the loan as a percentage of the overall value of the house, the percentage has now gone down. I talked through that quickly. Let me say it again. PMI is only if the bank has given you, the lender has given you more than 80% of the value of the house. Well, if they gave you 80% of the value of the house when the house was worth $300,000 and now the house is worth $400,000, the 80% that they gave you is now worth a much lower percentage of the $400,000 that it's worth. So you might now be in a position where PMI, private mortgage insurance, wouldn't be required. And there's a process to go to the lender to ask them to recalculate your basis. And our team's happy to help you with that. If you'd like to have that looked at on your basis, if you've been owning your home since before the real estate values went up and you're paying private mortgage insurance, we might be able to help you remove it. Give us a call, because once PMI goes away, private mortgage insurance goes away, more of the money that you're paying every month can go toward paying down the principal and building financial wealth for yourself. And it removes paying hundreds of dollars a month that are just protecting the interest of the bank. Now, I want to be clear, private mortgage insurance is sometimes a necessary evil, and if it's required for the type of loan that you're going to get, then it's something that could be helpful to you. But it's important to not pay it any longer than you have to. And our team would love to connect you to lenders that can help you consider those options when you're buying, or if you've owned a home and you're trying to figure out how to get rid of your PMI, we'd be happy to brainstorm with you. On behalf of Demetrius' team, the Real Estate Group, this is Aaron Chadbourne.